Hi, my name's Jordan Swigart from Swigart John Associates. I'm one of the audit partners at our firm. As a firm, we specialize in the audit of government entities. So today I've been asked to do a presentation on payroll responsibilities. Um, and so we're going to talk about payroll reporting and some other payroll common mistakes that we see. Here on the slide is my email, my phone number. As we go through this, if you have questions now or after, feel free to reach out. I'm always willing to answer an email or answer a quick question over the phone. So feel free to use that contact information. So kind of a high level outline of what we're going to go through today. First, we're going to look at some payroll forms for new hires, what you need to get for the new hires, how to fill those out, how long you should be keeping those. Next, we're going to be looking at what items need to be included in wages. There's some fringe benefits that we see quite commonly not being included in wages that should be, and some items that are included in wages that shouldn't be. So we're going to touch on those, hit some of the more common issues we see there. After that, we're going to discuss reporting. We're going to look at monthly, quarterly, annual reports, what should be included, how to fill out those forms, and timing of when things are due on those. So to begin, we're going to look at payroll forms for new hires. Want to understand what new forms you need to fill out, how long those forms should be kept, and how to fill out those forms, what to look for to make sure they are filled out correctly. So there are really three main forms for new hires that you need to have them fill out before they start working on their first day and keep on file in their personnel file. The first is an I-9. That's the employment verification form. We'll look at that briefly. The next is this Idaho State W-4. With the tax changes and with a new federal W-4 coming out, you need to have Idaho W-4 filled out because the way that your software, the way the withholding tax tables go on those, it does require a different W-4 now. After that, we'll look at the new 2020 W-4. There were quite a few changes on that. Really revamped how it was put together and what information was needed. So we'll look at that and who needs to fill out that new W-4. And then after that, I'm going to touch on the W-9, which is not for employees, but for contractors. But as we were going through this, something that we see quite a few errors with as we're working with cities. So first is the I-9. This is the employment verification, a pretty simple form for a new employee to fill out. The main issue there is how long to keep it on file. So while they're working, it has to be on file at all time. Once they leave working, then it's the longer of 3 years or 1 year after they're no longer employed. So if they worked for you for 2 or less years, you need to keep it until 3 years from the date you hired them. If they worked for 2 or more years, you need to keep it for 1 year after the date that they no longer are working for you. So we'll look briefly at the I-9 here. Again, a pretty simple form for the employee to fill out on their first day. The main item that you need to look down here on page 3 is in addition to filling out, you do need some documentation from them. You either need something from list A, which most of the time would be a US passport, if they're a non-resident, one of those, or if they don't have a passport, something from B and C. So you would need a driver's license and a social security card. That's the most common we see is driver's license, social security. So you would want to make sure to scan those in, keep a copy of those with the I-9, And again, keep that on file for the time periods that we discussed. The next I will touch on is the W-4 for the state of Idaho. So again, you do now need a W-4 specific for Idaho. With the changes in the tax tables for the state of Idaho, you're going to want to make sure that you have each employee filling that out. For retention, you just need to keep that for 4 years from the last time taxes were withheld. So if they worked in 2020, you'd want to keep it till the end of 2024. Very simple form, similar to what it's looked like what the W-4 has looked like in the past. All they need is their filing status, how many individuals they're claiming, and if they want any additional amount withheld. Pretty straightforward. Most likely can be filled out the first day they're there. They shouldn't need to take it home. They fill it out, and so you can have it on record and update your payroll software as you're putting them in as a new employee. The next one I want to touch on is the new federal 2020 W-4. There was some substantial changes to this new W-4 from all W-4s in the past. So a common question is, who do we need to get a new W-4 from? So anyone hired in 2020 or after needs to fill out the new W-4 form. Or any employees that during the year come to you and say that they need to change their withholding, they can't fill out an old W-4 anymore. You need to get a new W-4 from them. All other employees who are not changing, you can, for now, continue to use the old W-4 that you had on file. This does lead to two different holdings for employees, but most software has been updated to accommodate that and allows you to either put it in using the old W-4 information or the new W-4 information. Due to the complexity of the new W-4, this form, most likely they won't be able to complete on site their first day. This is probably a form that you'll have to send home with them, have them fill it out and bring it back to you before you're able to run payroll on them. And then as far as retention of this document, again, it needs to be kept for 4 years from the last time taxes were withheld. I want to briefly go over the new W-4 with you. So I'm going to kind of walk through the new W-4, point out some areas that we see mistakes or confusion around. Step 1 is pretty straightforward, just personal information and how they filed their taxes in the prior year. Step 2 is filled out if they have 2 jobs themselves or they have a spouse that's working. There is a great tool at the IRS website, this IRS W-4 app, a good tool for them to use if there are multiple jobs, multiple incomes reported on the same tax return to help prevent them from having taxes under withheld. And one thing I'll say about the new W-4, as I've went through it and looked at it, the feeling that we've seen is that it's trying to reduce the amount of taxes withheld during the year from paychecks, thus reducing overpayment of taxes and reducing refunds at the beginning of the year when you file your taxes. So because of that, if things are not filled out correctly on the W-4, it could lead potentially to owing taxes at the beginning of the year when you file your tax return. So very important that they take their time to go through it correctly. So step 3, again, pretty straightforward. They just take the number of dependents that they're going to claim times $2,000 and come up with a total down here. That is an annual amount, so it will be 2,000 times that. So that's the annual amount of that deduction for dependents. After that comes to step 4. This is where majority of the confusion we see is, and where biggest potential for errors are. That first line, line A, other income. So this is any income that they have that's not from another job that they have taxes being withheld on. So if they work somewhere else, that does not go in column A. But if they have investment income, if they have any sort of other income that they're getting that taxes are not being withheld on, they may put that amount there. What that does is it causes taxes to be withheld on that dollar amount, making it so that they're not going to have a larger tax bill at the beginning of the year when they file their tax returns. One important thing to note is that that is an annual amount. That's not the amount per month they make, that is their estimated amount for the total year that they would put there. Next, B, and we'll look at how to come to this number, but this is the deduction. So this is either their itemized deduction or standard deduction from their last tax return. Again, this is an annual amount. So this would be the total amount of that deduction. The last is C. This is if they want any additional tax withheld. If in the past they've owed money, they can put that in, whatever they want extra withheld here for that amount. Or if there are two incomes, either from working multiple jobs or filing jointly with a spouse that has income, an amount will flow through to here to help make sure that their taxes aren't being under withheld. Important note here, unlike the other boxes above, this is per pay period. So this is the dollar amount that they want withheld from each check, not for the whole year, but per check. The payroll software should have that so that when you put those in, it calculates everything else per check, but that number should come in per pay period. Then step 5 is just the signing. So that's the W-4 you'd want to keep. I'm going to skip down to look at a couple of those in more detail. First is the multiple job worksheet. So again, this only needs to be done if they either work 2 jobs or they have a spouse or someone that they're filing jointly with that is also working. What they need to do is come down to these tables here, and they look at the person making the lower wage and the person making the higher wage, and they come up to a number. What that number is the additional amount of taxes that will be withheld from the individual that is receiving the lower pay. And again, they would take that number here, divide it by the number of pay periods, and take that to number 4, which would go to those additional deductions on the W-4. Again, they take that and then divide it by the amount. So it becomes a per pay period dollar amount in line 4C there. This next one is their deduction worksheet to determine that deduction that they want to take up in 4B on the W-4. This, again, something that most likely they'll need to look at their prior year tax return, consult with their accountant to come up with those numbers, or enter the standard deduction and then come with that. Again, this is an annual number here, so it won't be divided by pay periods. It'll just be that total dollar amount. Again, so that is the W-4. Kind of some of the more confusing parts we've seen, but definitely something that as you have new employees fill out, just because it's a little bit more complicated, you might want to review with them, make sure that they have filled it out correctly, and have considered if there are multiple jobs, and taken all of that into consideration so that they don't fall into a trap of having to owe when they file their taxes. The next form I want to look at is the W-9. Again, not something you'd have employees fill out, but something you'd have contractors fill out. You should, for all contractors you have working for you, have a W-9 on file. the best practice we've seen to have that happen is to require a W-9 be on file before you can pay any invoices to that vendor. We've seen, a lot of cities have an approved vendor list of vendors that are known that they'll work with, and on that list, they have a W-9 on file for each of those vendors before they can get on that approved vendor list. So a nice way to be able to verify, do we have a W-9 or not? If they're on our approved list, we do. If they're not, they need to be set up. And to do that, you need a W-9. We find companies that if you call them when you get an invoice from them, say, hey, great, we appreciate the work. Before we can pay this invoice, we need a W-9. They'll get it to you very quick. If at the end of the year, you're going through and find out, oh, we need a W-9 for this contractor and call and ask for it, normally it's a little bit slower of a turnaround to get that back. You'll need W-9s to figure out who to send a 1099 to at the end of the year. We'll discuss that a little later. And then as far as retention, this should be kept for 3 years from the time you last sent or filed a 1099 for that company. Again, though, you do want to receive one of these for each of your contractors you have, so you know who you do need to send a 1099 for and who you don't. Looking at it later, just briefly, and we'll talk about this later, the main area you need to look at is this box 3. If they are a C Corp or an S Corp, or a limited liability taxed as a C Corp or an S Corp, they are exempt from 1099s and you don't need to send one. Any other items checked here would require 1099. If you're ever in doubt, it doesn't hurt to send a 1099. Even if they are a C or S Corp, it doesn't cause them any damage if you send them a 1099. So that's the common forms that need filled out as you bring on new employees and as you have contractors do work for you, things you'll want to look for and make sure that you're keeping on file. Next, I want to talk about fringe benefits, some items that should be included in wages and some deductions to make sure that they're not being included in wages. This is not going to be a comprehensive list by any means. It's going to be a list of some items that we most see errors with. So particular questions, certain circumstances, feel free to reach out. I'm more than happy to, discuss your specifics with you. And these are kind of general, high level, common things that we see. So we're going to touch on these fringe benefits that are pretty common. One is travel reimbursement. We'll discuss about when that is and isn't taxable and what documents you need to have around that. Touch briefly on health and medical insurance. Talk about employer provided vehicles. Discuss when that company vehicle used by your employee is or isn't taxable. Touch on group life insurance. So if you're paying for group life insurance for your employees, when that is and isn't taxable. And then talk about gift cards and recognition or end of year gifts. What is taxable and what isn't taxable. So first is travel reimbursement. So for travel reimbursement to be non-taxable, it has to meet the following criteria, and that's all of the criteria below. So first, it has to be out of the normal business area. So outside of the city, outside of where they normally would do business. Next, the travel needs to be for longer than a normal business day. So they need to be going out of town for a meeting. And then throwing in that third one, it should require an overnight stay or substantial sleep. So they could be driving, 8 hours to go pick up a vehicle, resting for 4 hours, and then coming back. That's that substantial sleep, or going 4 hours, spending overnight, and coming back. The next, if it meets those first three, then you can reimburse it as non-taxable. But to do so, you need evidence of the expenses. You need invoices, you need receipts from the hotel, from the food service that they received, any expenses that they're requesting reimbursed, you're going to need a receipt for that to keep on file. The only exception is if, per policy, you just say that you're going to do it at the federal per diem rate for your area, then you don't need receipts because you can just give the federal per diem and be done. With that, if you do reimburse over the federal per diem rate or more than the receipts show are reimbursable, then any excess needs to be returned in a timely manner to the city. Anything not returned, anything paid over the federal per diem or over the receipts that you have, becomes taxable income and should be included in wages for that employee. Next is health and medical insurance. This is pretty straightforward. For the most part, everything you pay for the employer, spouse, employee, the spouse, the dependent, not taxable to them. Any contributions you make to a flex spending health savings account, not taxable to the employee. Also, any contributions the employee makes for the health insurance, for flex spending health savings accounts, reduce their taxable wages and should be coming out before taxes. The other one that we see quite a bit in the area is AFLAC. AFLAC can be a little bit more confusing because some of their products are pre-tax, some of them are post-tax. So you want to really make sure to look at the bill. A lot of times the invoice will say what's pre-tax or post-tax. If not, you'll want to reach out to AFLAC and confirm that that things are being set up before and after tax correctly so that you're not over or under withholding for that employee. Again, AFLAC there is probably one of the more difficult things, and the one that we see a lot of times, either everything's set up pre-tax or post-tax when it should have been split out. The next is employer-provided vehicles. This is a lot of times something that we see cities have not given consideration to, but definitely needs to be looked at. So if you let an employee use a city vehicle and it's used 100% for business purposes, it is not taxable. So if they come to work, use the vehicle to drive around, repairs, whatever, bring it back, and then take their own car home, you're fine. There's no tax implications to that. That's using it exclusively for business purposes. If there is personal use of the vehicle, then there needs to be taxable income recorded for that employee. Examples of personal use: if they're driving it from home to work to commute every day, they're not driving their own personal car. They're using the car on the weekends for vacation. They're driving it all weekend to get groceries, how they would use their normal car, or a spouse or dependent are using that car. Really, anything that shows that they're using it as they would their own car, instead of using it 100% just for business or when they're on call for the business or for the city, then it falls into the personal use, and part of that value of that vehicle needs to be included as taxable wages for them. So if you do have any employee used vehicles that fall into that personal use category, you need to figure out how to value that use so that you can include it as wages. The first, one of the ways you can do that is by determining if the employee was to lease a similar vehicle, what would that be? What would the fair market value of that vehicle lease be? And then determining what percent of the time they're using it for personal use, and just taking a percentage of that market value, that fair value of that lease, and including that with every paycheck as taxable income on there. So you'd want to periodically look at that percentage and make sure if it's fluctuating that you're changing that and keeping on file documentation of how you came up to the market value of the lease and how you're looking at that percentage. Another way is a cents per mile method. To do this, at least half of the time, half the miles driven have to be for business purposes, and the vehicle needs to be driven at least 10,000 miles a year. If that is the case, let me go back there, I apologize. If that's the case, you just simply take the miles driven for personal use times the IRS mileage rate, and that is included as wages to them. So, if they are using the vehicle for personal use at all, you're going to want to make sure that some sort of mileage log is kept so that you know that and can calculate how much to include each paycheck as wages to them so that those taxes are being withheld. Next is group term life insurance. So some cities, as a benefit to their employees, provide life insurance for them. If the life insurance policy is for $50,000 or less, that's great. It's not taxable income. You don't need to worry about anything. If the value of that life insurance goes over $50,000, then you need to figure out how much the cost was for the amount over $50,000. You just take a percentage and say, if it was 100, half of the premium, because 50% over the $50,000. That would need to be included as taxable income on the employee's paycheck. You can either record that per pay period, or we see some do it quarterly or monthly. Just be aware that if you do it less frequently, then more taxes would be withheld out of that paycheck that you're putting that income on. Also, if you do provide life insurance to cover spouse or dependents, anything up to $2,000 is tax-free. Anything over that is not and needs to be included as taxable wages. So something to just keep an eye on if you are providing life insurance to make sure that it is being reported correctly. The next is gift cards, and that's kind of more gifts in general. So birthday gifts, recognition, a retirement watch, a holiday turkey, a ham, a box, Thanksgiving dinner, things like that are not taxable wages. Those are gifts and are fine. The thing that we see a lot that isn't done correctly are gift cards or gift certificates. Cities sometimes, in lieu of doing the turkey, ham, or turkey, will say, give a $50 gift card to a grocery store or something like that, or a $50 Visa card to the employees, just to show the appreciation, which is a great way to, to recognize those employees. The thing you need to be aware of is that gift cards, gift certificate, the IRS considers those the same as paying that employee cash. So it is considered a wage. So that does need to be recorded with their paycheck, and taxes need to be paid from the employee and the employer for their share of Social Security tax, and federal and state withholding should be held out of those. So as you're doing that, just make sure that you're aware that needs to be reported as wages, and those taxes need to be withheld from the employee's next paycheck to cover the taxes on that. So again, this was not a comprehensive list of fringe benefits, more the things that we see common mistakes on, common questions on. This website here, the irs.gov, is a great, it's about 125-page PDF that goes into a lot more detail of all of the items I've talked about and covers more items that are good to know about, but not common things that we see. So it's a great resource to you if you're looking at benefits of what is taxable, what isn't, and how those items should be reported. So now I want to talk about reporting, what reports you need to do, when those reports are due, and how to fill out those reports, especially some of the new, the 941 that has had some changes. So first, I'm going to look at some monthly reporting. We're going to talk about what forms you need to file monthly, how frequently you need to be paying your federal taxes. And we'll also, while we're talking about federal taxes being paid, we'll discuss the Social Security employee deferment of taxes. So first report we'll touch on is the Idaho 910. This report needs to be filed monthly. This is the state taxes that you've held out of your employees' paychecks. You can either pay it online with the Idaho TAP system, or you can mail in a check with the monthly coupon. Normally at the beginning of the year, they send you the coupons, the 12 coupons to cover the year. If you lose them, you can always call and get those, but you do need to use those personalized coupons because they have your tax information so that the state can make sure it's applied to the correct account. One thing I'll say is it's required to be done monthly. What we do as a firm and what we encourage others is if you're paying more frequently than monthly, it's not a bad idea to just pay that every time you pay, just so that it's not forgotten, it's not accumulating, sitting there, it's just done and you don't have to worry about that anymore. But is only required to be filed monthly. Just make sure that you're using your personalized form that has your tax information on it. The other monthly thing that needs to be done are federal taxes need to be paid monthly, at least monthly. So on your 941, your quarterly tax report, the IRS classifies you either as a monthly depositor, a semi-weekly depositor, or a daily depositor. So to do that, you have to look back at the prior July to June of last year. So for 2020, you look at taxes you deposited from July 1, 2018 to June 30, 2019. You look at how much you deposited, and if it was 50,000 or under, like on our example here for this 2019, it's 48. So that means for 2019, this individual would be a monthly depositor. And we'll talk about timing wise what that means. Here, this individual for 2020, because it was 51,000, they would be a semi-weekly depositor. And again, we'll look at timing wise what that means. The third option, like I said, is daily depositor. If at any point in one deposit you're depositing $100,000 or more, that triggers you becoming a daily depositor. And for the rest of that year, you have to deposit the next day after you pay payroll on all of those. So that monthly depositor, like we said, 50,000 or less in that look back period. By the 15th of the next month, all federal taxes withheld need to be paid. Semi-weekly depositors, it depends on when your payday falls. If your payday falls from Wednesday to Friday, you have to have it deposited by the following Wednesday. If your payday is between Saturday and Thursday, by the Friday of that week, you need to have those deposited. Similar to what I said for the state of Idaho, even more so on federal taxes, is that best practice is to do it the same day or the next day of payroll. There's too many things going on. It's too easy to miss, and the penalty and interest can be substantial if deposit dates are missed. So we always suggest to just do it the next day or the same day. So it's done. It's one less thing for you to worry about. Just getting it off your plate so you don't have to stress about it. But again, 100% your choice. The required dates are there for monthly depositors, the 15th, and semi-weekly, either the next Wednesday or Friday. So next, I want to touch real quickly about the presidential memorandum, the employee Social Security deferment. So what this does is it allows employees to not pay Social Security, which is 6.2%, from September 1st through the end of the year. In effect, giving them a 6.2% raise in their take-home pay. For employees to be able to do this, the employer has to opt in. So as a city, you make that decision if you're going to allow employees to do this or not. If you decide not to do it, then no employee can can say you have to let them. You get to make that decision yourself as the city. So for the next 4 months, the employee gets that 6.2% boost in what they take home. But it's not a forgiveness of that tax, it's just deferment of that tax. So starting in January 1, that tax that they didn't pay will be paid back over the next 4 months. So in effect, it's going to reduce their pay from December to January. Their pay is going to drop by 12.4%. So while they get a boost now, that does put a burden on them next year to repay that amount. Some things to consider as well is if the employee leaves, the Treasury guidance on this says that the employer needs to make arrangements to otherwise collect the tax. So if they do leave, it does fall on you as the employer to get that tax collected and submit it to the IRS. So tracking that, making sure that you get it is an additional administrative cost. So as a city, you need to decide if the benefit of boost of pay now is worth the cost of administrative cost of that and of reducing your employees' paychecks next year for the first 4 months to offset that. And that is an option that you have for the next 4 months that you can offer your employees if you choose to. Next, I want to touch on quarterly reporting. Really, this is around the IRS 941. With the CARES Act coming out, there's been changes to the 941, some new fields that you have to fill out, and some new fields that we get questions on that really don't apply to you as a city. So we'll kind of discuss those. So here is a copy of the new 941. The first part stays pretty close to the same. Where we see the first major change is this box 5A. On 941s in the past, that's just been a single line. You put wages there and you were done. With the CARES Act, there was exemptions for qualified sick leave and family leave with COVID-related issues causing sick leave and family leave. That if those wages qualified for that, as a city, you do not have to pay your 6.2% of Social Security. The employee still has to pay theirs, but you don't pay yours. So what you would do is put the wages that qualified for sick and family leave there and take that out of what you would normally put in Social Security wages. So Social Security wages will be everything you normally put in there, less anything in 5A, 1, and 2. And then as you carry that across, as you see, that's multiplied by 6.2% instead of the 12.4%, which is both halves, and you carry that down. One question we get a lot is, should we, as employees, have sick leave or family leave calculated and not pay that 6.2% as we do our, monthly, weekly deposits? And that is an option, but what I've suggested more is just to keep what you're paying the same so that you're not causing yourself more headache, more trouble. And then when you file the 941, as you go down here at the bottom, you'll come to calculate by what you paid versus what you say you owe, that you overpaid. And then you would just simply select here to have a refund sent to you and just get that check sent back. Up to you, but a little bit simpler. You don't have to do as much calculation, and you can just figure it all out at the end of the quarter at one time. The other new boxes that we see on here is these 11A, B, and C. With the CARES Act, there were other tax credits, refundable, non-refundable credits around sick leave and those. As a government entity, you're not eligible for those credits, so you won't need to worry about the items here and similar down here, refundable portions of credits, you won't need to worry about those. The other box that you could potentially have is 13B. Part of the CARES Act is as an employer, you could defer your portion of Social Security tax. And so if you did elect to do that, here's where you'd put the amount that you chose to not pay and you chose to defer. I haven't talked to any cities that have selected to do that, but if you did, that is where that would be reported. So we discussed that on the new 941, things to be lower there. Really, the biggest change that we've seen is sick leave, reporting that, putting that on there, and then most of the time requesting that refund at the end of the quarter for that portion of Social Security tax. So the last thing I want to touch on is some annual reporting requirements. I want to look at W2, W3. I'll look at some common reporting issues, errors that we see there. Talk about 1099s, when to send one, who to send one to, and then discuss the IRS Form 940. So first is the W2. So W2 is due by the 31st of January to be sent out to IRS, the state government, and your employees. So looking here, W2, really no changes in the W2 from prior years. But the two areas I want to talk about, first is box 12, and then talking about box 14. So box 12, there's a whole bunch of items. As we scroll down here, and the instructions for box 12, it gives you A all the way through HH of items that you could put in there. The common ones that need to be put in there, C, for any group life insurance that was paid over that $50,000 premium needs to be recorded in there. W, if you contributed to a 40, or apologize, if you contributed to a health savings account, that portion that the employer and employee paid need to go there. And then DD, if you pay health insurance for your employees, code DD should put in here, and the dollar amount you contributed should be put there. One thing to note with that is that's not a taxable amount at all. That's more information. It is a good way to show your employees the amount that you are paying on their behalf for their insurance, a good way to show them the value of that benefit that you are giving them. But again, not a taxable amount to them, just there for information purposes. The one thing you'll notice I did not say should be going in here is Percy. Percy should not be showing up in box 12. It should be put in box 14. Both the employer and the employee contributions, because it's a non-elected plan, because it's required, those amounts should go into box 14. Very common. Softwares will force that into box 12 and code it as if it's a retirement account, something along those lines. For the most part, that's not an issue. For 95% of your employees, that's not going to cause any problem, and it's fine. Not something to strongly stress about. Where it causes issues is if you have employees that contribute outside of work to IRAs and are putting money in retirement accounts outside of the city, and the dollar amount showing up there in Percy over contributing and could cause some issues there. So it is possible that when they take their W-2 into their CPA to do taxes, that there's issues and they might come to you say it's wrong. So just be aware that if possible, it should be reported in line 14 just to prevent any of those issues. The next thing I want to talk about here is the 1099. We talked about the W9 earlier. Again, doing 1099s at the beginning of the year already is a pain. It's one more thing you have to do at the beginning of the year when you're trying to get everything else wrapped up. But it becomes a really big headache if you don't have W9s for all of the people that you paid. So really getting those W-9s up front, having an approved vendor list to show who you have them to before you send payments is going to be a huge help to you with this. If you have those, then the question is, who do you send a 1099 to? So anyone you paid over $600 to, by default, you need to send them a 1099. Unless you have their W-9 and it's marked as a C or S corp, or a limited liability company being taxed as a C or S corp. If it's showing that they're exempted out, you do not need to send them one. The exception to that exception is if it's an attorney. If it's an attorney, regardless of their entity type, if they did legal work for you, you need to send them a 1099. That's the way the law is written. That attorneys always get a 1099. Anyone else, if they're a C or S corp or taxed as such, don't need to send them a 1099. You just need to keep that W-9 on file so that if the IRS ever did come audit you, that you can show why you didn't have to send that report, that 1099 to them. Again, just like the W-2s, due by the end of January to be sent to the individual, the federal government. Looking at that, majority of items that boxes we see filled out, one, rents. If you do pay rent on any sort of building, you do need to be sending a 1099 on that. That would go in box 1. The other, everything else normally goes into other income. Anything else you're paying there, construction costs, cleaning, any other services that people are providing, you would just put into box 3 and send when you send it out. The last report I want to touch on is the 940. This is the annual federal unemployment. We see some confusion around this with government entities sometimes, so I just wanted to touch on it. As a government, you're not subject to federal unemployment tax, so you should not be filing an annual 940. Along those same lines, you shouldn't be, when you're doing your monthly, quarterly EFTPS payments, you shouldn't be paying any federal unemployment taxes in there. So just, make sure that you're not withholding, not paying FUTA, and not issuing that 940 annual return. You don't fall subject to it. So one thing you don't have to worry about, just make sure it's not there. So that is a high overview of payroll, of reports, wages. If you do have questions at the beginning, I shared my email and phone number. Feel free to reach out to me. I'm more than happy to talk about specifics or any other areas that you want to talk about. I know it's a little weird this year doing it online, so please reach out to me. I'm more than happy to answer questions, get to more specifics with you on the situation you might find yourself. So I appreciate your time and send through this presentation, and I hope you have a great rest of your day.